fencing, sprinkler system, like for spraying or watering the plants. So you will install electronic system. So these costs are subject to decay, so they are depreciated. Land is not depreciated, but land improvements are depreciated. So what if we lease the land rather buying it? So improvements on the leased property, they are depreciated or amortized over lease term. So we'll see that whether this is a financial lease or ordinary lease or something. So there are different kinds of lease. One lease is after some time the asset belong to you. But one lease is like that. When time period is over, you have to return the asset to the owner. So ownership is not transferred, only possession is transferred. All right. So we'll do this kind of stuff. Now the question is, what if we purchased a lump sum or basket purchase which includes land and building? For example, of course, we cannot just purchase the building because building has to be constructed on land. If we acquire land with the building, and building we are going to use it, we are not going to demolish it, we are going to use that, then on balance sheet, building is written separately, land is written separately, because land is going to appreciate in future, building is going to depreciate. So how we are going to segregate those costs? So we use RSV method. We call this relative sales value method. So how we are going to use that? Let's just understand this illustration. Suppose FedEx purchased land and a building in Denver. The building sits on 2 acres of land, and the combined purchase price of the land and building is 2.8 million. All right, or 2,800,000. And appraisal indicate that the market value of the land is 300,000 and the building value is $2,700,000. So if you purchase separately, it would cost you $300,000 of land and 2.7 million construction cost. But you purchased it with 2.8 million. So would you record the land 300,000 and building 2,700,000? Answer would be wrong. Why? Because you actually paid 2,800,000. So you will apply RSV method, which is weighted average, you can say that. So what is the weight of land in your total purchasing? So total, if you purchase separately, so total cost is going to be 300,000. So what is the weight of land and what is the weight of construction? So land value divided by total separated value. So building value divided by total separated value. So answer is going to be 10% and 90%. But you paid 2.8 million. So it means 2.8 million, 10% belongs to building, 90% belongs to value of the construction cost, value of the building. All right. So in that case, 280,000 would be your cost of land, and 2,520,000 going to be your building cost. All right, and we are applying relatively sale value method, RSV method. All right, guys, you understand? Oliver, Nana,
Yep.
Momo, Marco, Joao Paulo, Priscilla,
Yes.
Subhan,
Yes.
Mirko.
Yes.
Yes, sir.
Good. So let's just move up. So what would be the Entries then. So we paid 48, 2.8 million. So cash gonna decrease by. So did we just pay cash, right? Or did we pay any notes receivable something? It means the building sits on two and combined cash and combined purchase price. So that means we paid it through cash because otherwise it will be mentioned that we paid on account. So cash decreased by 2.8 million, land increased by RSV method, building increased by RSV method. So total is 2.8 million. All right. So if you think about that, so that would be your after class participation stuff. So those who are watching online, please pause the video and answer this question. Okay, so let's do it together. How would FedEx divide a 120,000 lump sum purchase price for a land, building, and equipment with estimated market value 40,000, 95,000, 15,000? So if you add separately, that would be the 110, 150,000. But you purchase lump sum. So what is the value from this lump sum? The value of land, building, and equipment. Use RSP method. So I'm going to just go through by, a little bit fast because we need to close, cover all this chapter. So just remember that all you need to do, you need to find out the weights. How we find out the weights? 40,000 divided by 150,000. 95,000 divided by 150,000. 15,000 divided by 150,000. So the answer will be these weights. So that would be your values to record for land, building, and equipment. All right. Now, our second learning objective is distinguish between capital expenditure and immediate expense. So remember, when the word is capital is, when you see the word of capital, it means its intended use is for more than one year. All right. So whenever there is a capital expenditure, that would be the part of balance sheet, and all other expenses will be the part of income statement. All right. Why? Because its usage is for more than 1 year, whether it is capital asset, capital expenditure, capital liability, whatsoever, that would be the part of balance sheet. All right. And I told you what do we mean by the capital? Capital mean whose usage is for more than 1 year. So capital expenditures are which increase asset capacity or its extended useful life. So capitalized means the cost is added to an asset account, not expensed immediately. So what are those expenses? So capital expenses are, for example, in vehicle, major engine overhaul, which increases the useful life. All right. So we incur that expense to increase the life of the asset. Asset means like vehicle, any car or truck or something. Modification of the body for new use of truck. Okay. Additional storage capacity of the truck. While the ordinary repair are oil change, lubrication, tuning, tire replacement, windshield replacement, paint job. All right. These are ordinary expenses, which does not increase the life of our machinery, but this increase the life of our machinery. So we call this capital expenditure, and we add them to the cost of equipment, or in this case, cost of vehicle. All right. For example, you newly install the body of your copying Xerox machine, or you change its machine parts which increase the life of this Xerox machine, or you basically install that part which is latest technology inside the Xerox machine, and you paid something. So that would be added to the cost of the Xerox machine, rather going to the income statement. Third learning objective is, let's talk about the treatment for decrease in the value of plant assets, depreciation. So depreciation, what is depreciation? So now, if previously you don't understand the depreciation, now it's the time, because we will be thoroughly studying the depreciation. All right, so please be attentive here. Depreciation is the process that allocate plant assets cost to expense over its useful life. All right, so it means this depreciation is not maintenance cost, it is not any reserve, it is just spreading the assets cost to its number of life. That's it. All right, so it allocates cost against the revenue the assets helps earn each period. So simple, in 1 year this much. Okay, for example, you divide the cost. For example, you buy, or the cost price is 100,000, so you bought it for 5 years. The useful life is for 5 years. Every year 20K. Every year 20,000 is used to generate yearly sales. Basically, you are distributing its cost equally on 5 years. All right, so depreciation expense reported on income statement, not accumulated depreciation, because accumulated depreciation is contra account for plant assets, and that would be written on balance sheet. And remember, land is not depreciated, because land always appreciated. And why? Because land supply is limited. You cannot make the land, or you cannot generate the land. Land is fixed. So that's why during time to time, land value increases. So remember, depreciation is not the valuation process plus not, it doesn't mean that this is any reserve account or something where we just put cash on yearly basis and we say that when the asset is expired, so we buy a new asset. No, this is not the replacement account. All right, this is just we divide its cost on number of life of the asset use, and then every year we are taking that cost and minusing it from our revenue. Simple. So for example, you bought a Boeing 737 cost 32 million for 2 years. So what is the annual revenue? Annual revenue, it generates 9 million a year. So it means if you divide 32 million with 20 years, it's 1.6 million. So it means every year you use 1.6 million of Boeing 737 to generate sales of 9 million. This is what we mean by here. So you spread the cost of the airplane 32 million over 20 years, and every year you are using portion of its cost yearly to charge or to less from revenue 9 million. Or